Right now, one Australian dollar gets you about 70 US cents. Take a trip to London and that same dollar shrinks to roughly 52 pence. Fly to Switzerland and it buys you just 55 centimes. If you've ever looked at your bank account after converting currency and thought, where did my money go? You're not alone. Millions of Australians feel the sting every time they travel, shop online from overseas stores, or just compare our dollar to the greenback. But here's what most people get wrong. They assume a weaker dollar means Australia is a weaker economy. That's not how it works, not even close. The truth behind why our dollar buys less than the US dollar, the British pound, or the Swiss franc is a story that goes back decades, and it reveals something surprising about how money, trade, and global power actually work. Let's start with a little history most Australians have forgotten. Before 1966, we didn't even have dollars. We used the Australian pound linked to the British pound. On the 14th of February 1966, changeover day, we switched to a decimal currency. One old pound became two new dollars. That conversion alone cut the face value of every unit of currency in half overnight. It wasn't that anyone got poorer. It was a deliberate design choice. The numbers changed. The purchasing power stayed the same. But that single decision permanently set our dollar at a lower face value compared to the British pound. That gap never closed, and it was never supposed to. Then came the next massive shift. In December 1983, the Hawke-Keating government made one of the boldest economic decisions in our history. They floated the Australian dollar. Before that, the government set the exchange rate. After the float, the market decided what our dollar was worth, based on supply and demand. At the time, one Aussie dollar bought about 90 US cents. Today, it hovers closer to 70. That drop didn't happen because Australia got worse. It happened because the forces shaping our currency are completely different from the ones shaping the US dollar. So what actually drives the value of our dollar? The Reserve Bank of Australia breaks it into a few key areas. The first is interest rates. When the RBA raises its cash rate, Australian assets like government bonds become more attractive to overseas investors. They need to buy Aussie dollars to invest here, so demand for our currency goes up and its value rises. Right now, the RBA has raised the cash rate to 4.10%. That's the highest it's been since 2012. Markets are even pricing in a 62% chance of another hike in May. In theory, higher rates should strengthen our dollar, and they have, partially. The Aussie climbed from 64 US cents in late 2025 to above 71 cents in early 2026. But rates alone don't tell the full story. The second force is commodity prices. Australia is a commodity-heavy economy. We export massive amounts of iron ore, natural gas, coal, lithium, and agricultural products. When global commodity prices rise, foreign buyers need more Aussie dollars to pay for our exports. That pushes our currency up. When commodity prices drop, the opposite happens. Iron ore is currently trading above 108 US dollars per tonne, which is giving the Aussie dollar solid support. But here's the catch. We're deeply tied to one buyer. China takes a huge share of our iron ore exports. If China's economy slows down, demand for our resources drops, and our dollar feels it immediately. Traders even call the Aussie dollar a proxy for the Chinese economy. That's how tight that connection is. The third force is the US dollar itself. The American dollar isn't just another currency. It's the world's reserve currency. Oil is priced in it. Global debt is issued in it. Central banks around the world hold it. That gives the US dollar a kind of structural advantage no other currency has. Even when the American economy wobbles, the dollar often stays strong because investors treat it as a safe haven. So when you compare the Aussie dollar to the US dollar, you're not just comparing two economies. You're comparing a mid-sized commodity exporter to the anchor of the entire global financial system. And that leads to something most people misunderstand. A lower exchange rate doesn't mean your life is worse. The Economist created something called the Big Mac Index. And yes, it's based on your Macus order. It tries to measure what currencies can actually buy in their home country. According to their latest update in January 2026, a Big Mac in Australia costs about $5.70 in USD terms. In the United States, a Big Mac costs roughly the same amount, almost identical. That tells you something important. Inside Australia, your dollar's purchasing power is nearly on par with the US dollar's purchasing power inside America. The exchange rate makes the Aussie look weaker. The actual cost of living comparison tells a much more balanced story. There's also the question of what a strong currency even means for everyday Australians. A stronger Aussie dollar makes overseas travel cheaper and imported goods more affordable. But it also makes our exports more expensive for foreign buyers, which can hurt our mining sector, our farmers, and our international education industry. A weaker dollar, on the other hand, makes Australia a more attractive destination for tourists and students. And it helps our exporters compete globally. The RBA doesn't aim for the highest possible dollar. It aims for the exchange rate that best supports the overall economy. Now, right now in 2026, there are some specific pressures keeping our dollar below parity with the greenback. Global uncertainty is a big one. Geopolitical tensions push investors towards safe haven currencies like the US dollar and the Swiss franc, pulling money away from currencies considered riskier, and the Aussie falls into that bucket. Domestic inflation is another factor. Annual inflation came in at 3.7% in the 12 months to February 2026, still above the RBA's 2 to 3% target band, which creates uncertainty about where rates are heading next. And there's the sheer size of our economy. Australia's GDP is just under $2 trillion. America's is above $31 trillion. The volume of trade, the depth of financial markets, the institutional trust built over centuries, these things give certain currencies a weight that smaller economies simply can't match. There's another layer that rarely gets talked about, and that is the role of capital flows. Every day, billions of dollars move across borders. Investors in New York, London, and Tokyo are constantly choosing where to park their money. When they feel optimistic about global growth, they tend to move money into higher yielding currencies like the Aussie dollar. But the moment fear creeps in, whether it's a war, a banking crisis, or just a bad jobs report from China, that money flies straight back into the US dollar. This is what traders call risk-on versus risk-off behavior. And because Australia is considered a risk-on currency, our dollar rides the waves of global confidence. When the world feels good, we benefit. When it doesn't, we get sold off fast. That's not a flaw. It's simply the reality of being a smaller, open trade-exposed economy in a world dominated by a handful of financial giants. It's also worth understanding that the exchange rate you see on the news is not the only measure of our dollar's strength. The RBA tracks something called the Trade Weighted Index, which measures the Aussie dollar against a basket of currencies from our major trading partners, not just the US dollar. On that measure, the Aussie often looks much stronger than the headline number suggests. So when people say our dollar is weak, they're usually only looking at one comparison, the one against the world's most powerful currency. But here's what matters most if you live and work in Australia. You earn in Aussie dollars. You spend in Aussie dollars. Your rent, your groceries, your petrol, all priced in Aussie dollars. The exchange rate only hits you directly when you're converting currency, whether that's traveling, buying from overseas, or investing in foreign markets. For day-to-day life, what matters more is inflation, wages growth, and interest rates. Those are the forces that determine whether your money stretches further this month than it did last month. Understanding your currency isn't just trivia, it's financial literacy. And financial literacy is the one asset that never depreciates. If you got value from this, subscribe to the channel and turn on notifications. Thanks for watching, and I'll see you in the next one.